Malaysia sets itself apart from its neighbours in a region of high-growth, developing economies. It is situated here next to the strategic site of Malacca, which connects the Indian Ocean to the South China Sea. Malaysia is an exceptional country in this region. Its GDP per capita is almost double that of Thailand, and 2.5 times that of Indonesia. Within the Association of Southeast Asian Nations, or ASEAN for short, Malaysia ranks 3rd highest in labour productivity and very highly on the global ranking of economic competitiveness. According to the Global Innovation Index, Malaysia is the 34th most competitive economy in the world. What's more is that Malaysia is the world's 2nd largest exporter of semiconductor devices in the world, and is positioning itself in the future of the semiconductor industry with a plan to attract $100 billion in investment. In 2024, the country attracted significant investment into the AI industry, with billions invested by companies like Google, Microsoft, ByteDance, and more. Malaysia offers several advantages that position it as a major player in technology in the upcoming years, including a highly educated workforce, cheap land, and low water and electricity cost. In terms of standard of living, Malaysians also do better than their neighbours with low food and transportation cost, relatively low nationwide taxation, and fully functioning, though congested, single-payer public healthcare system. Malaysia seems to have everything going for it to achieve high income status in the coming years, and economists do predict that Malaysia could become a high-income country by 2028. But despite all this optimism on the surface, Malaysians have a lot holding them back from celebrating too soon. In this video, we'll look at how Malaysia got here, how it seems to be transitioning into a high-income country, and the major challenges holding it back that have Malaysians worried about their future. Of course, we need to learn a bit of context before understanding the modern Malaysia economy. Until independence in 1957, Malaysia was a British protectorate. Malaysia played a pivotal role in providing the British Empire with a variety of raw materials, and was one of the most profitable of the empire's colonies. At one point, it was the world's largest producer of tin and rubber. After independence, Malaysia continued to be a key player in the global economy. In the 1980s, it began to follow the path of the Asian tigers, Hong Kong, Singapore, Taiwan, and South Korea, shifting away from mining and agriculture. High levels of domestic and foreign investment, particularly from Japan, helped Malaysia develop both light and heavy industries, fueling an export-led growth model. As a result, the country consistently achieved over 7% annual economic growth throughout the 1980s and 1990s, with relatively low inflation. Malaysia was not an exception to the Asian financial crisis of 1997 that shook the once seemingly unstoppable growth of Southeast and East Asian nations. Speculative attacks on currencies in the region became common and even reached Malaysia's ringgit. The ringgit, which was free-floating at the time, meaning its price was left to the free market to decide up to supply and demand, fluctuated massively and quickly depreciated from $1, getting you 2.5 ringgit, then getting you 4.7 within just weeks. The panicked government pegged the currency and imposed capital controls, even including limiting how much ringgit a traveller can take out the country. Since then, the country relaxed the currency peg significantly, and is moving towards reducing capital controls fully. So, while Malaysia hasn't yet reached a high-income status, the quality of life is considerably higher than you'd expect because of the high quality of public services. The government invests highly into infrastructure, public health, and education, which takes up the largest share of government expenditure at around 14%. However, many describe Malaysia as now stuck in what's known as the middle income trap. The economy per capita today is approximately the same size it was in 2014, and countries like Indonesia and Thailand are catching up. For very poor countries like most in Africa today, and Indonesia before it industrialized in the 1980s, high economic growth is relatively easy. These countries have the advantage of a huge population which can act as cheap labor, And as these people move from low productivity subsistence farming towards much higher productivity industry, massive economic growth is generated. However, when most of the population moves out of rural areas and into cities to work in this industry, the fuel for the economic engine dies out, and countries get stuck in a space where they're no longer a poor country, but not yet a high-income country, hence the name middle income trap. A famous example is Latin America, which across the board is no longer a poor region, and has for the most part moved away from agriculture, but hasn't quite reached the income levels of high-income countries, and isn't making the necessary progress fast enough to catch up. A report by the World Bank suggests that Malaysia isn't stuck in the middle-income trap, but is just facing a temporary slump in GDP growth. That isn't to say that it shouldn't focus on renewed methods of growth. The ascension from middle income to higher income will need different things compared to going from low income to middle income. It won't just be about having the basic infrastructure to accommodate large-scale production and trade, but rather a focus on secondary and tertiary education, a reputable legal system, and the promotion of foreign and local investment that will take Malaysia to the higher income tier. These factors put together will allow the country to more easily adopt and attract high productivity service industries like technology. Another important part of becoming a high-income country is the high levels of investment needed into capital. Unfortunately, the lag in higher investment levels in Malaysia comes from the lack of trust from the private sector in the government's transparency and fairness. Malaysia ranked alongside countries like Montenegro and Cuba in Corruption Perception Index. Investors find it hard to be confident in investing somewhere where the rule of law is known to be broken for bribes. In comparison, Taiwan and South Korea, who used to have comparable incomes to Malaysia in the 1960s, now far surpass it and continue to grow at a fast, albeit decreasing rate. A working paper by the IMF suggests that the difference lies within the investment level of domestic firms in these countries. South Korea achieved a higher investment level when in the 60s it created numerous government enterprises in sectors from energy to banking, and gradually privatized them a decade later to improve productivity, while still maintaining some form of government financial support and protection from competition. Taiwan, on the other hand, saw massive government efforts to develop the private semiconductor industry, which culminated in Taiwan being one of the leading countries in the semiconductor industry today. In both countries, this was also coupled with increased government investment in secondary and tertiary educational levels. Despite these, the World Bank still sees that Malaysia can achieve high-income status by 2028 to 2030 with the right approach, that being increased training and education as well as increased investment. Also, in recent years, global demand for Malaysian electronic products has risen, becoming a key driver for economic growth. The country faces low unemployment at a rate of only 3.2% and stable inflation of around 2%. The country has the main macroeconomic indicators for financial stability. Still, a major external threat to Malaysia's good performance recently is the increased geopolitical tensions around it, especially when it comes to economic fragmentation, which is on everyone's mind right now, since US President Trump announced a wave of tariffs, placing fear on the integrity of global supply chains, which Malaysia is a key part of. The US and China, which are at the forefront of the global tariff drama, are both major trading partners of Malaysia, and a slowdown in their economies due to fear would have a ripple effect on the Malaysian economy. Yet, Malaysia is still determined to position itself at a pivotal position for the future of global trade. The government set out a plan to attract around $100 billion to further develop its already sizable semiconductor industry. In the state of Johor that neighbours Singapore, what once was palm oil plantations is now becoming data centres. Taking advantage of cheap labour, energy land, and proximity to Southeast Asia's primary financial hub, some of the world's biggest multinational companies like Microsoft, TikTok, and Nvidia are positioning data centres here. Malaysia's King announced efforts to integrate further with Singapore in the form of easier cross-border trade and taxes. The aim is to mimic the success China had with their special economic zones, particularly Shenzhen, which went from a small fishing village to one of the world's largest metropolises today and one of the most technologically innovative cities in the world. The city has changed the fortunes of millions, and the area around it and Malaysia is hoping Singapore can do the same with further integration. It's safe to say the government has succeeded in convincing the world in recent years that it will be the future of high-end manufacturing. Countries like Thailand and Vietnam are offering tax incentives to try and spark the momentum, but Malaysia has the unique advantage of a head start and reputation. Obviously, with an export-driven growth model, Malaysia enjoys a significant trade surplus that's been sustained over decades. A point of concern, though, is that around 20% of Malaysia's exports are based on oil and gas, representing a risky dependence on fossil fuels as the world is driving towards renewables. Additionally, Malaysia is heavily reliant on imports for food, and with the increasing rates of urbanization, its dependence on imports for food will only grow. This means that food prices will be especially vulnerable to changes in the exchange rate, directly impacting the well-being of citizens. Malaysian people are all too familiar with the harm of rising prices due to a depreciating currency when they lived through that in the 1997 Asian financial crisis. Another issue is that despite making huge strides in lifting millions out of poverty, Malaysia struggles with huge levels of inequality. The problem this creates while striving towards becoming a high-income country, which is the country's main priority right now, is that with the current trend, even if it does become a high-income country on paper, a huge portion of the population won't feel the transition's effects. A report by the World Bank points out that when Malaysia does reach that milestone, 6 out of 10 Malaysians won't be within the threshold that classifies them as high income globally. So a few people would be lifting up the country's average to meet the minimum, but the rest would still be far behind. This sentiment is felt by public opinion as well, with around 70% of people believing that the income gap is too wide, and around 60% of people think that the government should do more to address inequality. Malaysia has also been struggling for a long time with a lot of its educated youth leaving the country for places like Singapore, Australia, and the US, where they can get higher salaries. Although there are no official figures to show the level of migration, this is a problem frequently talked about in government. In 2011, the government created a government company called Talent Corp, specifically tasked to try and attract talent to Malaysia and reduce the migration of its educated workers. The CEO estimates that 1.8 million Malaysians left the country in the last 5 years. Statistics also show that a large portion of Malaysian migrants to Singapore, roughly 40%, are skilled workers. This goes to show that educated or skilled workers in Malaysia are prone to leaving the country and taking their talent and productivity with them to places where they can get multiple times the salary they'd get at home. The core problem to this issue, however, is the salary difference, which the government is quick to point to as a result of the currency differential, which is something they can't fix. However, the problem of lower salaries comes from the basic economic concept of supply and demand. In more developed countries like Singapore or Australia, there are more firms and larger firms demanding skilled workers, and a small population relative to the amount of work, leaving these firms no choice but to pay high salaries for the productive work they require. In Malaysia, though, there are less firms and smaller firms relative to a massive population, and so people have to compete by accepting lower salaries for the hope of work in a sector that might give them a better future. On top of these issues, Malaysians have another reason to be concerned about their future. Malaysia once was a star country praised for its high growth level and free economy, as it stood as a beacon of Southeast Asian potential in the face of the traditional Asian tiger economies. However, the panicked response Malaysia took in response to the Asian financial crisis of 1997 by imposing strict capital controls sent a strong message that certain liberties can be taken away when the government saw fit. Although the policy worked at stabilizing the financial system and currency, it marked the beginning of increased government control and mismanagement. In 2014, a newspaper exposed that the country's sovereign wealth fund worth billions was systematically robbed by high-ranking government officials in one of the world's worst corruption scandals in history. The Prime Minister at the time took a reported $700 million worth to his bank account alone. The fund's focus was said to be on strategic investment in the country, which would increase the wealth of the fund while funding development projects like infrastructure. In the end, the Malaysian people lost out on a future they were building and were left with a sovereign wealth fund that was more than $11 billion in debt. The whole thing was an embarrassment and a wake-up call that mismanagement was rife. The country's political system has also proven itself to be far from democratic. In just 6 years, 5 different men have been prime ministers. And while the government is busy handling corruption, the nation, which is trailing behind the identity of a first world country, is already dealing with the problems of one. The country is facing a demographic shift that is beginning to resemble one of an aging high-income nation. The problem is that Malaysia is not one, and even if it was, it will still face the problem of financing the needs of more older, retired people, while having less young working people. On top of the inequality issues mentioned earlier, Malaysia also has affirmative action policies aimed at redistributing wealth towards the ethnic majority, in an effort to keep wealth in the hands of the ethnic majority, rather than have it slip away to minorities or foreigners. The problem, obviously, is the unfair message this sends that reward isn't as correlated with effort or impact, but more so with who you look like in the case of affirmative action, and who you know in terms of high corruption levels. As Malaysia prepares to make the shift from a middle-income to a high-income country with major advantages, it lacks the proper foundation to make this transition stable. Red flags including corruption, changing demographics, and dependence on volatile pillars like a stable currency and oil and gas leave the country's future with very high potential, but standing on ice.